Mukherjea to answer exactly that. Saurabh, hi, good morning. Great to be speaking with you as always. Saurabh, you've always said that investors lose nearly 1% a year to bad timing. Having said that, from March lows, the markets have moved a lot more than 1%. Most investors, at least when it comes to small caps, were sitting on FOMO as well, and then they all started jumping in earlier this month. Having said that, from where you look at it, the market, both large, the mid and the small caps, would you say that much of the move is now behind us from the March rebound that we have seen? Or would you say better times are still ahead?
I think it's still worth being cautious, especially on small and mid caps, right? Because if I join the dots, we're more likely to be at the beginning of a rate hike cycle globally rather than at the beginning of a rate cutting cycle. So money is highly likely to get expensive in the next couple of years. Secondly, it's not evident to me that there is any easy resolution for the jobs issue in our country. I think AI will continue eating up white collar jobs like it has done over the last couple of years. And thirdly, if I look at the consumer debt overhang, right, we have the most indebted middle class in the world. I don't think that's going to make things easy for us. So if I combine that, right, it's not obvious to me why small caps haven't corrected more than they have. So if you take YOY, the large cap benchmark is down, but the small cap benchmark is up, and that doesn't make any sense to me. So I think in small and mid caps, I think there is scope for more correction. The one big bright spot I'm seeing in India this year, and this has been true through the Iran war, and it's holding true even in this quarter's earnings. I think large cap quality is making a handsome comeback after 4 years of hammering. So both on earnings growth, high quality large caps are reporting mid to high teens earnings growth. Valuations are at their cheapest. Large cap quality valuations are their cheapest in 10, 15 years. I think that's the one big bright spot of the Indian market. But overall, at the market level, I think earnings growth at the Nifty 50 level will be again subdued, and small and mid cap valuations don't make any sense to me. If I look at it from a cyclical and a tactical perspective, it's not clear to me why small and mid cap valuations in India should hold at these current levels.
But sort of just going to the point that you were making on large caps and them being safer, and, drawing back to what you said about investors losing 1% to just bad timing in the market, is the timing right for large caps right now, especially given the high rotation and churn that you see on a daily basis play out within the large cap pool itself?
So let me address it from a valuation perspective, just using this whole, the penalty point you're making, the timing penalty. So 6 years ago, HDFC Bank was, say, 4 times price to book. 2020, had we done this interview in 2020, Aisha, HDFC Bank was 4 times price to book, and the various PSU banks were 1 times price to book. Now HDFC Bank is basically 2 times price to book, and the better PSU banks are 1.5 times price to book. That gap doesn't make any sense to me, because I don't think HDFC Bank is just marginally better than the PSU banks. I think the gap should be bigger. And using that as an example, I think I'm seeing this across sectors. Top quality companies generating high teens earnings growth in a very difficult macro environment, right? Those watching, if we had a longer interview, I'd explain how tough this current macro environment in India is. But in a very difficult macro environment, I'm seeing high quality large caps being able to punch out high teens earnings growth at a time when the Nifty's earnings growth is barely 5-6%. And the valuation gap between a premium player such as HDFC Bank and, say, the better quality PSU, that valuation gap is the narrowest in 10-15 years. And that, to my mind, is an opportunity. And I could flip it on its head and say that's where I would worry if I was an investor in PSUs, or if I was an investor in low quality companies, irrespective of market cap, I would worry. So the market is giving us an opportunity at this juncture to exit lower quality names where valuations have still held up. Because of the unrelenting flow of money into mutual funds, valuations are still held up of lower quality names. The sorts of stocks that FIIs hold and hence have sold over the last 3 years, FIIs are big owners of large cap quality, and as everybody knows, FIIs have been selling for 3 years non-stop. Those sorts of stocks, quality large caps, are at their cheapest in 10-15 years. That, to my mind, is the big opportunity, because as and when the FIIs return, because if the FIIs don't return, the rupee will blast through 100 quite easily. So I think FII investors will return at some stage, and the most likely place they will start loading up is large cap quality. And that's where historically we've been positioned. It's cost us for 4 years, it cost us, but thankfully this year, both on the earnings growth front and on the valuation front, our quality positioning is bearing fruit.
But Saurabh, you have enough time, and I really want to know what concerns you about the economy right now.
So let's break it up. Three big challenges, right? And I don't think it's a challenge that we can ask the government to deal with one or two budgets. What we are seeing is impact of AI on jobs across sectors. We're seeing it in banks. We are seeing it in media. We're seeing it in IT services. Obviously, we're seeing it in call centers, right? It's evident. You can see it in, say, aggregate data sets like Naukri. We can, by Naukri, I refer to InfoEdge's asset, Naukri. You can see it in aggregate data sets like that. You can see it in the NASSCOM data, and obviously you can see it in annual reports. This is the first time since 1991 that over a multi-year period, India has stopped creating white-collar jobs. Out of every 100 graduates coming out of college, only 4 are getting full-time jobs, right? That obviously has challenges at 3 different levels. Firstly, it's hitting tax collections. Government's tax collection growth, especially direct tax collection growth, which is budgeted to grow at low teens, is struggling to get into double digits. Secondly, consumption. If we can't create jobs, we can't expect to drive consumption. And thirdly, borrowing. In the last 5 years, the RBI has repeatedly sounded the alarm on borrowing in their financial stability reviews. The RBI is basically saying household debt is growing at 22-23% year after year, and that's an unsustainable number. So this combination, lack of jobs, and remember the AI impact is just beginning. This is the shuruat. This is the beginning. This is the trailer of the AI impact. Lack of jobs, tax collections challenged, high household debt. I'm not even getting into more sort of transient issues such as the bad monsoon, such as the events in the Middle East and our sort of difficult relationship with the United States. Hopefully those are transient issues. I think the structural issues worry me, and I don't think the structural issues are reflected in small and mid-cap valuations. Large cap quality valuations, 2 times price to book on HDFC Bank, I think reflects some of the underlying challenges in the country. But small cap valuations at 30, 40, 50, 60, 70, to my mind, make no sense at all.
Okay. And Saurabh, therefore, consumption also will be a space which will get hurt. And just before I come to consumption, give us a sense, therefore, what sectors have overbaked some of the growth? Where is it that valuations look stretched in terms of the downturn which will likely come in the Indian economy?
So you're right. So whichever way you cut it, we will have to jack up savings as a country, reduce our borrowings, naturally reduce consumption. So looking at the RBI data, looking at India's long-term time series, comparing India to other markets, the current numbers are scary. We'll have to jack up savings rates. Net household savings rates are at close to 50-year lows. As I said, we are amongst the most indebted middle classes in the world. So savings goes up, consumption falls. I think that's the first rebalance the economy will have to do. The second is, as IT services exports struggle, we'll have to replace that with manufacturing exports. For that, the rupee has to get further cheaper. Rupee through 100 and good FTAs, more Europe-style FTAs will help us. I think that's the second rebalance that will take place. Less IT services exports, more manufacturing exports, which is what we are loading up on. And thirdly, I think government spending will have to pull back. Given how sclerotic, how anemic tax collections are, government spending will have to pull back. As the government pulls back, more and more of the services that the government provided will be provided by the private sector. People like us have loaded up for many years on hospitals and diagnostics. But I think other sectors, other public services, the government will also have to cede ground, and the private sector will come in, and people like us will invest in that. So 3 big rebalances for the economy: less consumption, more savings; less IT exports, more manufacturing exports; less government spending, and more scope for investors like us to buy private sector companies, essentially providing public services such as healthcare and maybe soon education as well.
Manufacturing, a little bit about that, Saurabh. Where's the tilt? What are you betting on?
So we analyzed the US FTA. Sorry, let me start again. We analyzed the UK FTA first, then the EU FTAs. Looking at those two, there are 5 big areas where we think we can make money, and that's where we're loading up. So firstly, auto ancillary exports. Secondly, precision engineering exports. Thirdly, pharma and the associated ancillaries feeding into pharma. Fourthly, footwear. And fifthly, textiles, garments, right? So 5 big areas, lots of FTA action, currency swinging in our favor for the first time in my lifetime at least. And finally, there's also other background changes the government is making, which I think will make exporters' life, manufacturing exporters' life easier. So places like Coimbatore, Ludhiana, the NCR, Surat, Baroda are humming with activity, and we're looking forward to spending more time in these places and buying more manufactured goods exporters.
Interesting.
Saurabh, you made a very interesting point about not just healthcare, but education as well as being a space. I'm sure you've done some homework there already because within the listed pool, it seems like a very limited opportunity so far at least. What do you think the education sector could look like 2 to 3 years from now?
Look, I mean, if you use, say, the Middle East as an example. So in Dubai, when I visit Dubai, all my friends and clients' kids study in effectively CBSE schools, but they are CBSE schools owned by the private sector. And many of the Dubai chains have 50 schools, 100 schools spread across the Middle East. So these are for-profit corporates operating CBSE schools in the Middle East on a large scale, running it just like, say, a Narayan Rudyalaya or a Max or a Apollo runs hospital chains in India. I suspect that corporate school model will come to India in the foreseeable future. I'm sure private equity will be very interested in loading up on that. Unfortunately, as yet, Aisha, I can't see listed plays on that theme.
Okay. Last question, Saurabh, with regard to how you're looking at the rupee. You suggested that the rupee will have to slip below 100 or go above 100 on the dollar for incentivizing of manufacturing exports. But that will keep FIs away, right? I mean, wouldn't that create a cautious environment from a flows perspective?
So 2 parts to that. Just firstly, let me just delve a little bit deeper as to why I think the rupee will go through 100, should go through 100. India's current account deficit historically has been around the 1% of GDP mark, say $35 billion mark. But that was with huge support from IT services. IT services was bringing in $300 billion, sometimes more, of foreign exchange. I think that story ends. And therefore, there's a good chance that the current account deficit moves towards 2% of GDP, which is more like a $70 billion number. For us to offset that, we need $70 billion of incoming capital flows. I find it hard to believe we'll get that either just through FDI or just through FII. I think each FDI and FII each have to bring in $30-40 billion in so that we can balance out, we can cancel out the current account deficit. For us to bring in $30-40 billion of FDI, FII, both FDI $30-40 billion, and FII $30-40 billion, we will need a cheaper currency. Now, the good news, let me end with some good news here. 5 times in this century, 5 times so far in this century, we've had this following double coincidence. The double coincidence is the rupee gets hammered against the dollar and India gets hammered vis-a-vis emerging markets, right? So 5 times we had this double coincidence, rupee hammering to the dollar, India hammering to EM. Every single occasion in the subsequent year, India has outperformed EM. I think that double coincidence is well known to FIIs now. They can see that large cap quality is cheap in India. They can also see the rupee has been hammered. They appreciate that there is some more downside risk to the rupee. But I think the beginnings of foreign investor interest in India hopefully should be emerging as we go through the 1Q earnings season.
Okay, Saurabh, great having you here. Thank you so much for coming in, giving us those views. Very interesting.